Good morning, everybody. Chris 70 with 70 Mortgage Note Investments. We are a SEC qualified Regulation A plus offering, raising $75 million to invest in distressed mortgages. Today, we're going to talk about the difference between a syndication and a fund, because a lot of times those terms are used interchangeably, but there are a lot of differences between the two. But first, they're both used for passive investments. And since 2012, when the Jobs Act passed, that really allowed for sponsors to use different types of investment vehicles that were either exempt from the SEC or required SEC registration. So what's a syndication? A syndication is an investment vehicle where there's a general sponsor who will go out and raise money from multiple investors into an entity structure based off of typically one investment, meaning that they'll go buy a multifamily building, an office building, but whatever they're buying, it's typically just that one investment. A fund, on the other hand, is similar in the sense that there is a general sponsor who will go out and raise money from multiple investors, but it's for multiple assets. It's not just for that one multifamily building. For example, the fund that we are running currently, as of this video in early December, we have over 100 assets within our fund. So those are really, the main two of the main differences that I want to just right off the bat mention. Another one we'll talk about is the length of investment. With a syndication, you got that one investment, so the investment time period is going to be based off of the exit for that investment. So I'm just going to use a multifamily property because that's what most people are familiar with. And when that asset gets sold is when you would get the monies back out of that deal. So in the offering, or the PPM, which is the private placement memorandum, which is a 50-page document that outlines a lot of those terms, it'll typically have a range of 5 to 7 years, 5 to 9 years. So it can vary significantly on the exit, and it is again truly based off of that one asset. A fund, on the other hand, can be open or closed, meaning that investment periods are only open to a certain, you have to invest by a certain date, and then it'll have a period. Those also fluctuate a little bit like syndications, but those are also somewhat a little bit rarer. Typically, you're going to find a fund which is called an open-end fund, meaning investors can invest at any point in time, and their money can be taken out based off of the offering circular, or again, that private placement memorandum. For example, again, I'll use our fund as a simple example. When you invest, you can get your money back after 4 years. You do not have to wait until all our assets are sold. So there's people constantly investing in and out of those types of deals. So a little more flexibility, as you can see with the fund. Next, I want to talk a little bit about due diligence. So we've talked about the syndication with the one asset, the fund with the other asset. Due diligence is going to be very similar, but there are a few slight things that you want to focus on as part of due diligence. And we have other videos that we talk about how to vet your sponsor that we can leave links to down in the notes below. But first and foremost, of course, is vetting the sponsor, understanding their track record, their experience. Have they done this before? Do they have a criminal history? What is their team? What happens if the key man, something happens to that key man or woman? So you've got the company itself. And then on the syndication, you want to focus on that asset. So what is that asset they're investing in? You want to review the numbers, get an understanding, make sure it's in a market that you're comfortable with. On a syndication, that asset is usually picked out in advance. Now on a fund, it's typically called a blind offering, meaning you're investing and they haven't completed all their acquisitions because they're constantly raising money. But it's based off of a business plan or types of investments. For example, again, our fund is primarily invest in mortgage notes. Now, we can own some rentals and some other types of real estate assets, but it's very closed in the sense of we're not going to go do crypto. We're not buying other companies. We're not going to become an insurance company or a loan originator. So it's very defined business plan. And you want to make sure you understand that business plan as part of the offering. So in the fund, you focus on the plan and the sponsor. On the syndication, you focus on the sponsor and that asset. Now, we've talked about both these. How does diversification come into play? And as you can imagine, in the syndication, it's one asset. It's not very diverse. If you want diversification investing in syndications, you're going to have to invest in multiple syndications. And we'll talk about that in a moment, because investing in syndication typically requires a lot more from capital. When you're investing in a fund, the diversification is there because you're investing in multiple assets across, it might be one or two asset classes, but still multiple assets. For example, again, rolling back into our fund, we've got over 100 assets. We're in over 25 states. It's a mixed portfolio of performing loans that providing cash flow and some non-performing loans that we're working out with the borrowers to get them on payment plans to get that cash flow also coming back in. A lot of people may use the analogy of a syndication is like investing in a single stock, whereas a fund is like investing in a mutual fund or an ETF, because it's not just relying on that one asset, it's based off of broader markets. So we mentioned about diversification. I made a little comment about diversification in a syndication. And I mentioned that because of investment minimums. Typically in a syndication, you have to be an accredited investor, which means you have to make over $200,000 a year, over $100,000, $1 million net worth outside primary residence. If you have a spouse, I believe it's over $300,000. Please don't quote me for this, as the laws continue to change about the definition of an accredited investor. But if you're an accredited, typically you can invest in syndications. There are also some syndications that allow for non-accredited investors, but the minimums are typically 25, 50, or 100,000. So it's significant money you're investing. And again, that's why due diligence is extremely important. So if you want diversification, you may need $100,000 to $200,000 to diversify across a wide portfolio. A fund, on the other hand, typically requires, contrary to belief, lower investment amounts. For example, again, our fund, $500 minimum. People say, well, why is your minimums so low? One is we allow anyone over 18 to invest in our fund, but our systems and our team are built to handle thousands of investors. Syndications typically may have 25, 50, maybe 100 investors tops. Funds typically will have thousands of investors. So they're already built to be able to handle the number of investors between the software systems they use. For example, the software we use, not an issue whether we have 10 investors or 10,000. And again, the people on the back end as well who are part of our investment relations team. So key component too, because in a fund, if you can get in with $1,000, you still want to do your vetting. But if there was ever an issue, God forbid that something were to go wrong, again, diversification and risk, your risk profile is much lower because you can get in an issue with a lower amount. And in a fund, if you invest a lower amount, you can always add to contribute as you get more comfortable with it. So people, next question they always ask, what about the returns? What's the returns between these two types of offerings? Syndication, typically will provide a little better return because of the risk. It's a higher risk profile compared to a fund. But when you're looking at the returns, you're going to hear a common phrase called preferred return. And what a preferred return is, after expenses, the first money that comes in the door of profits typically is preferred, meaning goes to investors. And I'll put a little caveat next to expenses, is when you're reviewing the offerings, check for management fees. Some offerings, instead of just having people as expenses, they'll charge a lot of upfront fees. And you want to be careful because sometimes those fees can be exorbitant and become a profit center. So again, preferred return, that money comes in the door. Typically, you're going to see average 6 to 10%. We're going to see, look at 8% right now, which is what our fund is at. So the fund makes money. That first 8% goes to investors. And then the next question is, well, what happens to the rest of it? What's that upside go to? Some syndications will give investors upside. Funds typically do not. Again, because they have a lower risk profile typically, so their returns may not be as significant as the syndication. So they may keep those to cover, again, their expenses, and it's where some of their fees again. But again, you're looking at a completely different risk profile with hundreds of assets that are mixed component versus again, going back to that stock, one stock is a lot more volatile than typically a complete market. So covered the investor returns. We've talked a little bit about kind of the risk involved throughout this process. Just want to, again, hit upon it. First, if anybody ever guarantees a return to you, run for the hills. Hang up the phone, block their number, don't even talk to them. There's no such thing as a guaranteed return. Unless you're putting in a bank account that's under 250 grand, or you're buying something, a T-bill or something from the federal government, nothing is quote unquote guaranteed. Now, back to that risk again, we talked about diversification, and we've also talked about the due diligence. Those are really the two biggest risk factors. As anybody knows, you do want to diversify that portfolio, and a fund typically gives you that better diversification. Or again, you can go back and invest in multiple syndications. And again, vetting that sponsor is so important. Again, a link to a video that we've done about that. We've done podcast episodes. It's very important to understand. Far too often you read things in the news about sponsors either losing everybody's money, being indicted. It happens once in a while. I think the news overinflates it, and sometimes people get worried based off of the number of investments that are out there. It's kind of like a plane crash in my mind. Yes, it does happen once in a while, but there's also, thousands of syndications going on at any point in time as well. So in summary, it's really up to you. What fits your criteria? Don't be forced or pushed into investing in a syndication or fund. Invest in what fits your criteria. What is your risk profile? Both options are used to generate passive income, but it really is more focused based on what is your preference. For me personally, I prefer the fund because slightly lower risk. The returns are not that dramatically different. They're very similar, to be honest. And the exit is much more known. And being somebody who's a control freak, I want to know when I can exit that deal. I'd rather be able to pull my money out in 4 years versus potentially not being able to pull it out for 7 to 9 years. And I'll mention that because, again, recording this today, I've spoken to several investors recently in multifamily deals where in today's environment, multifamily transactions are basically at a standstill because of interest rates. There's no multifamily properties really being traded or sold at this point in time. But what's happening is a lot of the loans for those are 5-year loans that are now maturing. And what happens when the loan matures, these loans are based off of the revenue and the income. Expenses have gone up significantly. Granted, rents have gone up, but if they don't meet the DSCR, which is the debt service credit, if they don't meet that, then they might have to have a capital call. And I've had an investor I talked to who not only couldn't take their money out, they had to put more money back in. And it's not because it's a bad deal, but it's just because of the timing and the financials behind it that now all of a sudden they have to refinance. The exit they're off on the exit, and now it's prolonged. And that's something personally for me, I'd rather not have to deal with. I'd rather be in a fund where I know I can get my money in, get me out. So whichever one you do is really a personal preference. The one thing I'll stress to every investor again is that due diligence up front. So hope you found this video informative on the differences between a fund and a syndication. If you want more information, make sure to go to 7einvestments.com. That's the number 7, the letter E, investments.com. Thank you and enjoy your day.